Hello everybody, myself Surajit Ghosh, welcoming you all to my channel High School Commerce. In this video, we will cover one topic called prior period item, and in next few minutes I will cover up the definition and key concept of prior period item, treatment of prior period item, presentation of prior period item into the financial statement and its required disclosure. So let's begin with definition. If you notice, the prior period item, the name itself is telling that it is not relating to the current financial statement. Anything which is relating to the period before current financial period. For example, we are in 2024-2025 financial year. Any transaction that could be income or expense or any such events which we are supposed to cover in say 2023-2024 or 2020-2021 or 2018-2019 that we have not covered erroneously or intentionally, or we have omitted, and because of that the accuracy of the financial statement is in question. So to rectify those errors, when we are making some adjustment, it is known as prior period item. Let's have some example of prior period item. Suppose we are following WDV method of depreciation, and we have calculated wrong depreciation in say 2020-2021 period, and because of the wrong calculation of the depreciation, the WDV amount, the written down value of the asset is wrong, and we are charging depreciation on the wrong written down value. As a result, the current year depreciation amount is also wrong. So to get it reflected correctly, we have to start from 2020-2021 when we have made the first error, and once we adjust 2020-2021, the WDV amount of 2021-2022 would be correct, and so on. So mathematical mistake. Next one is misapplication of accounting policy. I can recall in one of my clients, they have an internal accounting policy that any expenditure, irrespective of its nature, if it is below 5,000, we will not consider it as capex. Straight away we will consider it as opex. Means any expenditure below 5,000 threshold would be considered as opex. There is no need to consider other conditions they have to judge the expense as capex or opex. But the accountant has made error, and he has considered all the conditions apart from that 5,000 capex ceiling. So they have charged those expenses into capex. As a result, the capital value or the asset value has gone high, the depreciation amount is wrong, profit amount is wrong, the retrospective impact in the current financial statement is also wrong. To get it correct, we have to revise the past financial statements so that we get a correct value of asset, and accordingly our financial statement will show the true and fair view. Another example of prior period item could be that one invoice intentionally or unintentionally has not been recorded into the prior year, although that invoice is relating to prior year, or it has been recorded twice. So in both the instances, not recorded or recorded twice, intentionally or unintentionally, the number that has been shown into the financial statement is wrong. So we have to correct it, and that correction we need to do through prior period items. There are certain misconception or confusion students or people have with prior period items, that is change in accounting estimate and change in accounting policy. Suppose I have a debt of 20,000 and I used to make a provision on it, say 10% for last 3 financial year. However, the scenario or the condition or the credit worthiness of the debtor has changed, and because of that I need to increase the provision on that debt from 10% to 15%. So there is a change in accounting estimate, and because of that my provision amount would be changed from current financial year. In that case, although the credit worthiness is not the result of one incident or one financial year, it is the retrospective impact of past activity, we will not restate prior financial statement. We will simply start making prospective application. That means from current financial statement onwards we will follow 15% as we are discussing in the example. What about change in accounting policy? The change in accounting policy, the policy itself will tell you whether you need to follow retrospective or prospective, and how you need to calculate, and what all disclosure you need to give. That will be given by all this detail you can find it into that respective policy or change in accounting policy. Means in both the cases, change in accounting estimate or change in accounting policy, the user or the preparer of the financial statement is not making any error. But in case of prior period items, we have made certain error into the past, and because of that we need to restate the prior period financial statement as well as current period financial statement to report accurate number. Hope now it is clear what is prior period item, change in accounting estimate, and change in accounting policy. Now moving to the next one, that is treatment. What would be the treatment into the financial statement? Accounting Standard 5, Indian Accounting Standard 5 and International Accounting Standard 8 tells that prior period items needs to be disclosed separately into the income statement, and because of that you need to restate your prior year financial statement or statements. Intention is to report correctly, correct number should get reported, so that the user of the financial statement get better visibility on it. And as far as the disclosure is concerned, the reason or the error because of which the restatement needs to be done should be visible into the notes to the financial statement, and its implication also needs to be shown. In next few slides I will describe it in detail. So in income statement, the prior period items are not allowed to get it merged with any other line item. It needs to be shown separately so that the user of the financial statement can understand its impact separately and distinguishedly. For example, the company has made a handsome profit of say 200 crore in the current financial period. However, there is a prior period adjustment of say 25 crore. Because of that, the profit is going down to 175 as compared to the prior year profit of 180 crore. When you are comparing the current year net profit 175, anybody will say that company has not made any improvement, rather its performance has gone down from 180 crore to 175 crore. But that is not true. The company has made a handsome profit, and there is an increase in profit as well from 180 crores to 200 crores, almost more than 11% growth in net profit. Now, why I am able to tell you that company has made a better result as compared to the prior year? Because the prior period items has been shown separately. If it has not been shown separately, if it has been merged with any other open item, then the resultant figure would be 175 crore in the current financial profit, and as compared to the prior year, which is 180 crore, anybody will say the company has not performed good. So that's why, to overcome such situation, it has been asked to show it separately into the income statement. And how it would be shown into the balance sheet? For that, the prior period profit or loss, if it is shown separately into the balance sheet under retained earnings or accumulated loss, the prior period items needs to be adjusted with retained earnings or accumulated loss retrospectively and respectively as well. In case those prior period profit or loss gets adjusted with equity, then prior period items need to be adjusted with equity. Okay. Now, disclosure into the notes to the financial statement. We have to give the disclosure that what is the error we have made, why we want to restate, what is this impact, what is the calculation method we are following, and if it is relating to any significant event, that also need to be disclosed into the notes to the financial statement. The whole purpose of this disclosure into the income statement, balance sheet, notes to the financial statement is to bring the transparency to the user of the financial statement. That could be an investor or potential investor or any other stakeholder, so that the numbers that we are reflecting through our financial statements give them a confidence, and basis on that they are going to take decision and they are going to make some future plans. So the reliability of the financial statement should not be under question. That's why it has been asked to show it separately along with its disclosure. Hope I have covered your doubts, and if you like my content and video, I would request you to put a like in this video, and do not forget to subscribe my channel by clicking into the bell icon, so that whenever I upload any new video you get the immediate notification. Into the comment section, if you want me to cover any other area, please feel free to raise it. And also, if you have any further doubt relating to prior period items, please put your question over there. I will reply you back. Till my next video, I would request you to stay tuned with me and be in touch and stay happily enjoy your commerce journey. Till then, bye.